Well, I deal a lot with sellers and buying real estate on payment terms. And when I'm dealing with people that are about 65 and older, I hear inevitably, well, I don't know how long I'm going to be around. I don't want to take payments for that many years, things of that nature. And a good friend of mine and mentor, he used to say it's inconvenient to be asset rich and cash flow poor
Right.
and run out of money. So, these people that are saying, well, I want to get my chunk or my balloon payment or whatever in 3 to 5 years, typically they squander that money and they don't have the asset anymore. So it's not appreciating. And just like you described, the money itself is trapped just like a bond. Welcome to the Generations of Wealth podcast. I am your host, Derek Dombeck. And you know what? Today's show, a little different than what we usually do, but that's a good thing. So my guest, he's not a real estate investor. He is actually spent the bulk of his career in stocks and bonds and those types of investments, but he is really passionate about helping people do things the right way in building wealth, preserving wealth, and that's what we're going to talk about a lot. And again, his perspectives, I've not heard them put in this way, so I really, really enjoyed the show. Before I bring him on, um, before I recorded this podcast today, I was part of a mastermind group and a discussion with about 30 of us talking about raising private capital specifically to real estate. And it was a really good conversation that led to a lot of perspectives that I don't think a lot of you think about. And so if you are either interested in becoming a private lender or you're looking to raise capital for your own transactions, reach out to me. I'm happy to help, happy to give you those perspectives and try to help you avoid any hurdles or pitfalls because it happens a lot. So reach out to me, derekdombeck.com, thegenerationsofwealth.com. And as always, we're here to try and help you. So with that, I'm going to bring on our guest and we're going to have an awesome, awesome show. And here he is, the myth, the man, the legend, Mr. Jonathan Blau. How are you, sir?
I'm doing well, thanks. Nice to be with you and your audience today.
Well, we do appreciate you giving us some of your time. We were talking a little bit off camera. You're what you call the snowflake. We usually call a snowbird. But
Yeah.
you're down in Florida right now, but you're from New York. So why don't you start us off? Just give us a little bit about you, and we'll have a fun conversation.
Of course. Yeah. First, let me distinguish for the audience, since we brought it up, what the difference is between the snowflake and the snowbird. So the snowbird is a person who comes to Florida and lives here consecutively 6 months or more. And the snowflake is the person who comes and goes month by month for a couple of weeks at a time.
Well, if we were getting political, there'd be a different term that snowflake gets used for. But we might get there. You never know.
Who knows? Who knows?
So, what's your background, Jonathan?
So yeah, so my background is based professionally is based in planning. I have a master's degree in tax and an MBA in accounting, and I worked with one of the big six accounting firms, Arthur Anderson, way back when in '92, in their what's called Family Wealth Planning Group, where we helped wealthy people plan for retirement and estate planning and all that kind of stuff on from the tax side of things. And then I joined what was then the largest privately owned wealth management firm in '96 after almost 5 years in accounting, which was called Sanford C. Bernstein and Company. Now it's Alliance Bernstein. There was a merger back in 2000, and then went through a few iterations of working for what are called the wirehouses, the Merrill Lynches and the Smith Barneys of the world. In 2013, the technology had advanced to the point where we didn't need them anymore to do what we do, and we started Fusion Family Wealth. And we focus primarily on helping wealthy families, not by picking the best investments, because nobody knows what that means consistently, but by helping them avoid the repeated behavioral mistakes that we all make. And the wealthier we are, the more of them we make because of something called overconfidence bias. We think that we're immune to it.
Well, I think we're going to definitely dig into that a little more because, interestingly enough, the same thing happens in real estate to real estate investors, and everybody has this view that, oh, it's never going to go bad. It could never happen to me, or it can never happen again, and we all know that's BS.
Of course. Yeah, one definition that relates to that of behavioral finance that I like, it's behavioral finance is when you're reading about a horrible outcome, a string of bad investments, bad luck, and you're reading about something that you think happened to someone else, but it's actually something that happened to you and will also happen to you again.
Well, I think that's a great place to kind of start. But probably before we do that, you know, the show is called Generations of Wealth, and it's not just financial wealth. It's, all encompassing. So spiritual wealth and relationship wealth and everything. But how do you define wealth?
So wealth to me is defined in the best way that I can as the ability to wake up, do what you want with who you want for as long as you want, whenever you want. And when you achieve that, you're wealthy. There's no dollar number attached to that.
I absolutely could not agree more. And it's easy to get caught up in the financial aspect of wealth, but that can quickly deteriorate the other aspects of your wealth.
Yeah, absolutely. You become a prisoner to your wealth. Not a good thing.
Yeah. So has that definition changed over time throughout your career for you?
Sure. Yeah. Before I got into behavior 15 years ago, behavior means helping people in general, doesn't have to be investors, learn how to suppress the human nature biases that we're programmed with to help us to survive without thinking in the African savannah millions of years ago, when a lion was going to attack us, right? The amygdala, the fear sensor in our brain shoots off a signal and you're gone. You don't think about it. But the problem is when we're making life decisions that are not life and death based, but most of the time these days, financial decisions under uncertainty, we have to learn how to slow those biases down from, it's called the amygdala hijacking our rational thought process. And that's a challenge that we find. So in the old days, before I learned all of that, I used to define wealth like probably 98% of the people in wealth management do. How much money do you have relative to whomever you're comparing it to?
Yeah. And I think there's so many aspects of it that you obviously have spent years studying and living, right? But a lot of people I meet, I just turned 50
Happy
and
birthday.
oh, yeah, thanks. It's great. Um, but, I'll meet people that are 10, 15, 20 years older than me and they think, specific to real estate investing, they think they're too old to get involved, or the opposite side of that coin, right? 20-year-olds that think they're too young to get involved.
Hmm.
And it's really just a mindset. Um, I have also met people that are in their 70s and 80s and are still extremely active in real estate investing and other investing, and they love it. They'll never quit until, they're in the grave. Um, what do you feel like is, in your opinion, the mindset of, or by age group, that you kind of come across?
In general, you mean?
Yeah, well, wherever you want to take it.
Yeah, so basically, I'll give you an example. We say people get involved. Oftentimes, people want to get involved because of some narrative or what they saw someone else do with what they're trying to get involved in, but they have no idea what it would mean to them, or even whether or not they have the temperament to get involved and successfully stay involved with it. So that's a whole other set of issues. But age oftentimes is misused as an excuse to do the wrong thing. So, for example, I recently had a prospective client, recently in the last year or so, that was in the mid 70s. And my whole philosophy is that the industry, the wealth management industry, misdefines risk and safety in terms of temporary fluctuations in the value of our assets due to market dislocations or politics or whatever else causes the market to fluctuate. And those temporary fluctuations in the number of our dollars, the industry calls volatility. want to protect you against volatility. See, the older you get, the more you need to protect against volatility.
Mhm.
And the irony is not only is volatility not a real risk, but in trying to protect against what I call the illusory risk volatility, you're actually taking on more of the actual risk, which is not the temporary fluctuation in the number of our dollars, temporary being the key word, but the permanent disappearance to at least 3% a year inflation rate of the value of every one of the dollars. The markets and great companies haven't only historically always recovered, they've gone on to wild new highs. But when you lose 3% a year to inflation, you never recover that. And so when you redefine risk and safety in proper terms, not protecting against temporary fluctuation, but permanent disappearance of the value of the dollar, then you recognize that bonds and things like that are risky because they lead to the freezing and diminution of your purchasing power, the value of your dollar. And
Mhm.
stocks, investments in real estate, real things are safe because they lead to the preservation and accretion in the value of your purchasing power. So, contrary to what the industry tells people, stocks are safe and bonds are risky. And at the end of the day, so I'm speaking to this 75-year-old, and he said, "So you don't like bonds at all?" I said, "No, my philosophy is when you're in retirement, you should have 2 to 3 years of spending." So in this gentleman's case, he had $10 million in his liquid investments. I said to him, "What do you spend a year? 400,000. So have about $1 million outside of equities, and that protects against what I call sequence of return risk. If you're retired and now a 2008-9 comes along, the value of companies in their stock prices go down 60%. Well, you don't want to have to liquidate those losses to support your lifestyle. So you switch to the 2 to 3 year spending pool you have set aside outside of stocks. And what that does is two things. One, it allows you not to have a traditional 60% stock, 40% bond portfolio. In this gentleman's case, it would be maybe $1 million of 10 million, 10% bonds.
Yeah.
So, and at 75 today, you have a 15-year life expectancy, jointly, you and your wife. So at the end of the day, for 15 years, if he kept the extra 30% on the industry advice, the 60/40 portfolio, an extra 3 million instead of 1 million in bonds, just at 7% a year in 10 years, it would be 6 million, and then it would be 9 million in 15 years. Instead, it's frozen at 3 million. He's turning his children's inheritance into wallpaper for the perceived safety of being less volatile at the expense of giving up the returns of equities, which after inflation are 2.5 times more than bonds. And so he said to me, "Well, that makes sense, the 2 to 3 years living expenses, because historically for 100 years, it's taken 40 months or 3 years to go from a peak in the market value, the S&P is at 7,000 or so today, to a
Mhm.
trough 33% lower, 5,000, and back to new highs. That's taken 3 years. So as long as you have 2 to 3 years, you're okay." But he said, "But does that apply to someone who's 75? And that may be good for someone who's 50." So I said, "It's an interesting question." So I said, "Let's revisit the premise. We keep 2 to 3 years living expenses because historically that's the average of how long it's taken to go from a peak to trough and back. Does that average change for a 75-year-old versus a 50-year-old?
No.
No. Okay. So yeah, so this still works for you."
I I know you're going to be shocked by this. I've never heard anybody explain it that way.
No, I'm not shocked. No, the industry doesn't look at things this way,
It was a
but you
little,
see,
it was a
you
little,
understand what I'm saying, right? So
yeah. I was
so
being a
him living.
little rhetorical there, Jonathan.
No, I
But
get it. I'm teasing you. So at the end of the day, he basically was trying to use his age as an excuse to stay on a plan that was not going to serve his family well. I mean, if he lives 4 more years instead of 15 more years, then the family's inheriting the money anyway. He doesn't need to
Mhm.
spend it. But if he
Right.
lives 15 years and he needs to spend it, he better darn well make sure he's not freezing too much of it in the face of inflation so he can still spend what he needs to buy as inflation grows up.
Well, I deal a lot with sellers and buying real estate on payment terms. And when I'm dealing with people that are about 65 and older, I hear inevitably, well, I don't know how long I'm going to be around. I don't want to take payments for that many years, things of that nature. And a good friend of mine and mentor, he used to say it's inconvenient to be asset rich and cash flow poor
Right.
and run out of money.
Yeah.
So, these people that are saying, well, I want to get my chunk or my balloon payment or whatever in 3 to 5 years, typically they squander that money and they don't have the asset anymore. So it's not appreciating. And just like you described, the money itself is trapped just like a bond.
Yeah, right. It's they don't have the self-control, right, to get a lump sum and not spend it.
Yeah.
Particularly if they've gone a few years without being able to do it, right? So now all of a
Right.
sudden they're free.
Right. What kind of got you inspired to start focusing on this type of building wealth? Was there like a trigger point or something that happened?
Yeah, definitely. So when I left accounting and joined Sanford Bernstein at the time in 1996, they were the largest privately owned money management firm, and they had a 6-month training program. And at 29, I was actually the youngest person at the time they'd ever hired to directly act as a financial advisor, as opposed to an associate to a financial advisor.
Mhm.
And the people in my training class, there were maybe 15 of them or 12 of them, were all people in their third career who had big Rolodexes to attract clients. I was not at all. I didn't fit that model. So I was lucky to get in. I sold myself to them in an interesting way, but I was lucky enough to get in. And so 2 days of the 6 months, they touched on behavioral finance. And back then it was very new. It's still relatively new, but then it was very new. And so it just stuck in the back of my mind. And in 2000 to '02, after I had accumulated maybe 50, 60 million in assets, my
Mhm.
first couple of years, I watched them turn into 30 million because the dot-com bubble burst and the terrorist attacks happened.
Yeah.
And I found that I was on the call with the clients today, the same call I had a month ago and a week ago, talking off the same cliff each time. And then got through that, rebuilt my business, so we had maybe 80 or 90 million. And then in 2007, it went down by 60%. So now I had, instead of 80 or 90 million, 35 million left. And the same thing, I was found myself, I'm talking the same people off the same ledge today that I did a month ago, a week ago, and 2 weeks ago. So I said, there's got to be a better way to help people than having to do that. And there's got to be a smoother practice methodology. So it just occurred to me I have to do the lifeboat drill before the bow of the boat touches the water. When everyone's panicking, I can't help them. But if I
Right.
teach them, hey, the market goes down 15% a year since 1980, expect to see 15% of your equities appear to disappear in value every year. And it goes down about twice that amount, a third, 1 year and 5 or 6. That's the average bear market. And what I've always found is surprise is the mother of panic. So now the investors I deal with are not surprised. You know, Jonathan, you told me that's part of the package. I
Mhm.
can't get my 10% a year that the equities have gotten for the last 100 years unless I'm willing to be in for every ounce of the volatility involved with that. It's part of the plan. The plan isn't working any better for the last 5 years when you compounded 15% a year than it was in 2008 and 9 when you lost 60% temporarily.
And I compare that in real estate terms to people that were, in my opinion, foolishly buying apartment complexes at a 4 cap or a 5 cap
Right.
and had short-term debt, 3 to 5 year calls on them. And now they're shocked when interest rates, commercial rates are 8, 9%, and they can't cash flow.
Right.
That wasn't shocking at all. It was common sense,
Right.
but it's the same thing. In the
Yeah. For
short
those who
term,
come into these things based on narratives, they don't have the experience you have. So they
right?
didn't know what they were getting into to begin with. So they were surprised. Right.
Hmm.
And surprise is the mother of panic. How do I get out of this thing?
Right. And then they bail because
That's it.
they don't have a choice in a lot of cases. They're bankrupt or go into foreclosure. And the next crop comes in, buys at a discount, rides the upside, and hopefully doesn't make the same mistakes. But
Right.
yeah, it's very similar. So you're not a real estate guy by nature, right?
No, no.
And having you on the show, that's what I love doing with my show is to bring different perspectives in because a lot of real estate investor based shows are kind of repeating all the same shit all the time.
Right. Everybody's coming at it from the same angle. It's like it's kind of in behavior what you call uh, teaching people to not engage in confirmation biased searches. Don't
Mhm.
search only for the terms that confirm what your bias is. In other words, if you think the market's about to go down 30%, all your searches have been tell me why the market's likely to go down 30%. You need
Mhm.
to search tell me why the market's not likely to go down 30 to give yourself both sides of it, right? Instead of
Right.
influencing your bias and then making a decision without all the information that you can get.
Definitely. Definitely. Well, so let's say that, somebody's coming in, they're a real estate investor listening to my show, and now you're piquing some of their interest in alternatives to what they're used to. How do you manage risk when you're entering into a new investment or a new market that you're not familiar with?
Yeah, so basically, it's just trying to teach them, right? So we don't look to convince anybody of anything, but one of the things you have to do is understand what their goals are. So if somebody's majority of their investments are in real estate and they're expert at it, right? What I always find is a lot of the wealthy people that I've met in that position, without meaning to be, they tend to be selfish. In other words, they know pretty well that when they leave this earth, their spouse can't handle it, and then they're going to be leaving this earth at a time when maybe it's not fortuitous to have to sell the real estate, but they have no choice. There's an estate, they need money, and so forth. So for those perspectives alone, right, it's important to rethink. There's no good or bad in owning real estate or equities, but real estate tends to be it's one asset. It's real estate. Sometimes it's geographically concentrated for a lot of people who do it and things like that. And it's leveraged to a certain degree. So with equities, since I was born anyway, they've gone from about 60 to 7,000 on the S&P. And so they've gone up almost 100 times. So a million is 100 million. Inflation's gone up about 10 times. So I need 10 million to buy what a million used to buy. I've got 100 million. And my dividends when I started were 3% or 30,000. But the dollar dividends being paid out by the S&P companies because they increased 6% a year were $2.50. Today they're 80. So now my 30,000 in income's a million in income, right? And I've used no leverage. And in that period of time since I was born, the S&P declined by half or more three times, in 73, 4 in 2002, and then again in 08 and 09, 60%. And within inclusive of those three times, there were about 13 or 14 other bear markets, meaning down at least 20%, 12 recessions, interest rates as high as 18, as low as zero, almost an equal number of Democrats and Republicans, and inflation as high as 18% and as low as almost zero. And through it all, what someone had to do to be able to not just keep up with inflation, but to beat it by about 10 times on the asset level and by 30 times on the income level is to buy the S&P, put it in a drawer, elect to reinvest dividends, and not look at it. But human beings can't do that. But if I leave this to my family, what they would inherit today is instead of the million, they inherit 100 million, and they're getting $1 million a year in income, which is like getting 100% on a bond. There's no leverage, and guess what? They don't need any expertise to manage it. They're not forced to sell it. It's completely liquid, and it'll continue doing what it does. And so that's the difference, right? So it's important for people again to understand what they're getting into, and the returns were for that period of time about 10.5% a year.
That's what it averaged out.
Yep. And with very little taxes, because if you buy, we only invest for our clients in index funds. If you invest in index funds, you're only paying a tax on the dividend annually, which is about a 20% federal tax. And then the capital gains don't come until you sell. And we don't sell until we need the money. In general, you can rebalance from time to time, but those aren't big gains. And so it's a very tax efficient and cost effective way to build enormous wealth in a way where you own the best companies in America and the world. You get the totality of human innovation in every industry and geographically spread out and everything else. So it's a great, it's like I look at it as like a miracle,
Yeah.
compounding that way effortlessly, other than the emotional side, right? Which is what we help with. But otherwise, it's effortless to do that. It's like a miracle to me.
Well, and I've had people on the show a handful of times talking about generational wealth using life insurance plans and other things like that. But essentially, what you're describing can be generational wealth unless it's squandered by the next generation.
I say it differently. It can't not be generational wealth. In other words, if you invest this way, and history is anywhere near what it was for the last 100 years, it can't not be generational. I mean, because the average person needs to spend 4% a year of the portfolio if they are planning properly. And if they're making 7+%, it's in a 30-year retirement, you've got generational wealth.
Yeah. So you had mentioned all the ups and downs, the recessions, the bad days or bad years, I should say. We've in general had a pretty long run, whether it's in real estate as well as the market. What do you foresee coming 2026, 2027 maybe?
Nothing. Can't for nobody can foresee anything. If they answer that question
Mhm.
any other way, you should stop the video and take them off. The one thing I always teach everybody about the one defining characteristic there is about the future is there are no facts about it. Nobody can tell you with any degree of certainty at all, not 1%, what tomorrow or next year. And what I can say is that the market hasn't had, if you look at the last 6 years, we forget things. Say, oh, it's had a tremendous run, but we forget things. In the end of 19, nobody had an idea that we were about to have a 1 in 100 year plague take over the whole world.
Mhm.
And not having had that idea, they couldn't certainly predict that we would have an unprecedented 34% decline in 33 days from February to March of 2020. Without having been able to predict that, they couldn't have predicted that while the global economy shut down in response to the pandemic from about February, March of 20 for another year, that the market would go up 80%. Because
Yeah.
what people don't realize is the market and the economy have nothing to do with each other in the short run, only over the very long run, because the economy can't outgrow or undergrow the companies that make it up in the long run. The short run, it's all over the place. And then nobody, after that 34% 1 month decline, would have predicted the next year we're going to have a 40-year spike in interest rates and inflation in
Yeah.
2022, right? When the pandemic was over. And then we're also going to have an invasion of Ukraine by Russia, and the market would go down another 25%. And then
Mhm.
after that, no one would have predicted that Trump was going to throw in these tariffs. And then in April, in one day, really, the market went down 20% of 25. So you had over the 6 years, three declines totaling, the 34 plus 25 plus 25, so about 90%. And yet the market before that period began at the end of 19 was 3,300, and today is 7,000. It's more than this, made 15% a year, one of the best 6 year runs in history. But it certainly wasn't smooth. It was anything but smooth. It's a life lesson for an investor who doesn't accept that if I'm going to get the 10% a year types of returns, I've got to be in for every ounce of the volatility. The economy can't be forecast consistently, nor can the market be timed. So the only way to get anywhere near those returns is stay in it. And once you learn that lesson, what happens next year? Who knows? Who could have predicted in 2019? Some idiot would have come on and answered your question and said, "Oh yeah, next year I think the S&P." Oh, but I couldn't know about the year after. Well, you said this, but I couldn't know there was a pandemic coming. And then in 2022, I think we're going up 30%. Well, I couldn't know inflation and interest rates were going to spike. That's the point. Nobody knows anything
Yeah.
about a year or 6 months, and so that's a lesson. I'm saying it a few times because people. There's this guy Phil Tetlock who's widely known in the industry about forecasting. He wrote the most seminal work on forecasting, his research. And what he found is two things that were interesting. One is he found that the efficacy of expert forecasters, they're right about 49% of the time. So you can use a coin and get to the same
Mhm.
efficacy. But what he found out, which is more dangerous, because people who watch CNBC, for example, is the better educated and the smarter sounding the forecaster is, the worse their predictive efficacy is. And so who are you going to listen to? You're listening to the smarter sounding and the better educated one. So forecasting and all that is just throw it out the window. But understand long term, right? As long as the economy grows and the population grows and innovation continues, that companies are going to continue to grow. And uh, and also, I teach people segregate in your mind the stock market from the great companies that you own, because nobody owns the stock market. The stock market I define as one of the craziest forums where some of the craziest people aggregate every day to react to some of the craziest things and then do the craziest things in response. It had nothing to do. So when the market goes down 30%, what you have to do is say, hey, the price of the stock is down 30%. But is the long-term enduring value of these companies down 30? Of course not. So in the best way, when people panic, I say, take a drive to the mall, go into the Apple store, take a look at their new products, go in and buy yourself a Starbucks, and then go get a pair of Nike sneakers, and then go home and tell me how many packages from Amazon are sitting outside your door. So the point is, the 30% decline is not stopping you from patronizing all these businesses, and they're going to continue to grow. The price of these companies are down. That means the opportunity is just better to buy them now if you have cash. But the long-term enduring value hasn't changed, and so there's nothing to panic about once you understand the stock market and stock prices are different than long-term enduring values of great companies.
What's your and I'll preempt this with I am not a crypto guy.
Yeah.
What's your take on crypto, whether it's your personal opinion or maybe clients that you work with? And for me, I don't love something that I guess is computer controlled, so to speak. But I'd
Well,
love to hear
you
your.
better check out because with AI, everything's about to become.
Oh, yeah. Oh, I know.
Well, I'll answer it. I mean, I don't have a predisposition to anything, but what I will say is, to me, to be something to be called an investment has to be able to have a readily identifiable valuation methodology. How do you value it? And then it has to generally should produce an income, right? Should have some kind of yield, something tangible that way. Bitcoin, anything else is not a bad thing. It's just everything else to me is a speculation,
Hmm.
right? Because you have nothing to base your decision to invest in it on, right? Just like picking red or black on the roulette wheel. So to me, Bitcoin, one, can't be adopted broadly by companies as a medium of exchange because it's too volatile. No one's going to do that. You go out of business. Two, based on the arguments I've heard, well, but it's limited. It's 21 million Bitcoin. Well, what if I had little bags of poop with a certain bag that's also limited? Because a limitation make it more valuable?
Yeah.
So I don't see how to value it. It's like Warren Buffett also said the same thing. And his late partner, Charlie Munger, said, what happened? Two guys woke up one day, he was being facetious, and rub their hands and say, okay, I'm going to create a currency out of thin air. So I understand a little bit because I've read up on the blockchain technology and the applications that it has economically. And I think that'll continue to evolve. Bitcoin may or may not go to $1 million a coin, and it may be replaced by some other digital coin that's backed by the US or governments in general. So the point is, it's a speculation. What I teach my clients is take the core of your money and invest it in what for the last 100 years has been able to be counted on to produce returns that would more than get you to your retirement in both income and dividends and appreciation. And then if you need 6 million to do that and you have 8 million, then take the 2 million and play with it. And then I tell them, if you come back to me for more than the 2 million, we part friends because I'm not going to take a fee to help you blow yourself up.
Right. Right.
But I also tell them I hope the 2 million turns into 200 million. I'm not rooting against them.
Oh, absolutely. I remember I got a good buddy of mine, when Bitcoin went over 100,000 and he was just we were actually together at the time it happened and he was like, "Oh, I just made X number of dollars today." I said, "No, you didn't. Unless you're going to sell today, you didn't make
Right.
that."
True.
So it's all perspective.
It's true. And also, look, it's like anything else. The people I found when I asked them for a real explanation of the value of Bitcoin, a lot of it to me is what Warren Buffett has called esoteric gibberish. At the end of the day, there's something I call market-driven optimism or pessimism bias. It's when people buy something because it's going up.
Mhm.
Market-driven optimism, not the underlying philosophy of the investor. When it goes down, they sell it. Market-driven pessimism bias. And in many things like Bitcoin and other investments that you really can't really know how to value, that's typically what happens.
Mhm. Well, Jonathan, I have a really hard question for you. My regular listeners know what's coming. What's one question I should have asked you that I didn't, and it can be about anything?
One question you could have asked me that you didn't, and it could be about anything. All right, let's see what that is. You can ask me, what is it? How do we define? How does wealth relate to happiness? Maybe that's a good question.
Perfect. What's your
I think
answer?
that's always helpful for people.
Yeah.
So What's interesting is that our brain produces dopamine. It's usually called the chemical,
Mhm.
and it's like a drug. Once we get it, we want more of it. Once it settles down, and so when we're buying things, we we kind of have that dopamine rush. And then when I bought the brand new Ferrari, great. Now I have it, dopamine's gone. So now I have to buy something else because there's no more dopamine. Same thing with a new house and a new vacation and a new so chasing wealth does not lead to happiness because things are not what makes our brain happy. It's dopamine that makes us happy. And the other thing is that there's something called the man in the car paradox. So we'll get that new Ferrari. We'll go to the valet, and the valet's a young teenager, and he's watching us drive in, and we're thinking, this guy, he thinks, look at, he thinks how cool I am.
Mhm.
Nobody cares more about our stuff than us. That kid wasn't thinking how cool the guy was. The kid's thinking, how cool would I look if I had that Ferrari? You could give a darn about that guy. And that's what we need to realize. If we really want to be happy, it's not about money. There's plenty of people with more and more money that aren't happy. One of my friends in the business who's 72 in the behavioral business, he said something on my podcast a month or so ago, and he said, "You show me someone who's happy, and I'll show you someone who's wealthy. I don't care if they live in a castle or a tent."
That is a very, very good quote.
Right.
Speaking of your podcast, it's called the Crazy Wealthy Podcast.
Yes, yeah, Crazy Wealthy Podcast. They can get it on crazywealthypodcast.com or Apple, Spotify, all the venues. And we do two different versions. One is kind of what we did today, an interview with somebody interesting. And then the other is a 10-minute or so monologue where I call it Fix It Friday, where I identify a faulty thought process we have, what causes it, and how to overcome it.
Well, everybody definitely needs to go check that out. I jumped on Spotify before we started recording just to peruse through it. It looks like you've been putting it out for what, year and a half, almost 2 years.
Yeah, since last November.
Yeah. So awesome. Well, Jonathan, thank you for your perspective. As I said before, I like to bring people on with different things to talk about, different expertise for that reason, because otherwise we all, as real estate investors, we get tunnel vision and we just think what we're doing is the best thing out there and it can be and it can't be. It's all
Well,
perspective.
no, it's nice. Yeah, you're taking an approach to podcasting that's not confirmation bias. You're not just inviting guests that confirm your bias. You're inviting, let me see the other side of things, the other views.
Absolutely. Well, we'll wrap it up with that. Again, thank you so much, Jonathan.
My pleasure. It was really nice to be a guest here. I hope the audience gets some value out of it. And Derek, I appreciate you inviting me.
Of course, of course. So for everybody else, here's another show in the can. We appreciate you. If you're coming back regularly, if you just found us, go back and listen to our other shows. We just released show number 100, and so it's been a good run for a couple years for us as well. And until the next show, go out, live your vision, and love your life. See ya.